Hey guys, welcome back to another video. My name is Mark Wilson and today we're going to be looking at how to position size in Forex, and we're going to be explaining in this blog and in this video lots and leverage. So let's get into it. The learning outcomes for this blog will be explaining lots and how they help you trade. We're going to be looking at how to properly manage your trades in Forex and what your broker screen may look like. We're going to be giving you a calculator tutorial, a position size calculator tutorial, one that we've created here at Logikfx and will really improve your trading. We're going to be explaining what margin is in Forex. We're going to be looking at the hidden truth behind your broker's agenda behind leverage, and we're going to be giving you a guide to how much money you will need to start your trading journey, among other information. Now, you will notice that there are 2 points here and here that are highlighted in red. Now, this is because they are going to be covered in a separate video, which will be just above where the tutorial is in the blog. This will be done by Matty. I think it will also be on YouTube, so look out for that there. But effectively, he's going to go into detail on giving you a proper tutorial in the calculator, showing you how it works, and how it can help you as well. So he'll go through all of that in that video down there, so we won't cover it in this video. It is covered also in the blog, so make sure you read that as well. Anyway, without further ado, I'll be blabbering on more. Let's get into it. So what are lots? In the trading industry, when we're referencing lot size, we're talking about how much of a currency or an asset we're trading at any given time. As Forex traders, we use the term lots to give us a base metric telling us how many units of a currency we are trading. Now, units of a currency are effectively they tell us how much of a currency we're actually trading. So lots and units are very they're effectively married together. So if you look at this table here, you'll see what I mean. So we have standard lot, mini lots, micro lots, and nano lots. Now, nano lots are not available in the US. They are available in some European brokers, so watch out for that. Standard lot size is 1.0 lots, and that is equivalent to using 100,000 units of a currency, and that's a lot of units of a currency. So yeah, you have mini lots that are equal to 0.1 lots, and that is equivalent to trading with 10,000 units of a currency. One micro lot is 0.01 lots and is equivalent to trading with 1,000 units of a currency, and one nano lot is equivalent to 1.00 lots and effectively is trading 100 units of a currency. Now, how do they help your trading? Well, to understand this, you need to you need to take into 2 factors: your risk management and your leverage. Your risk management is going to be looking at how many currency units you actually want to use, whether you use maybe 100,000, 1,000, what kind of lots you're using. 0.1, 0 micro lots, mini lots, whatever one you want to use. This is your risk management. Now, we recommend risk management is key when using lot size, as you need to be able to maintain your positions. You need to know how much of your capital is actually at risk at any given time, so that if you're over trading, or you could potentially trade more at a safe pace, having your capital at risk and knowing how much of your capital is at risk will definitely help you a lot in learning about leverage and everything else in the future. Now, leverage, a short way of explaining it, it allows you to borrow money and inflate your capital, allowing you to buy more currency. However, it can be very dangerous, but we're going to get into that much later in the video. Once you come to terms with these factors, you'll be better placed to choose the ideal lot size for you. You should also remember that you can still engage leverage when trading with smaller lot sizes, though the ratio will not really increase. Now, here we have an example of what your Forex broker screen may look like when you're looking at entering a trade. On the left hand side, we have 3 key definitions for you. Bid price, this is effectively the price that is the best price that you can sell the currency at. The ask price is the best available price for you to buy the currency or asset at, and the spread is the difference between the bid and the ask. So or the ask and the bid, whichever way you want to work it out really. This varies with every broker. Some brokers will give you more, some brokers will give you less. If you're only opening a practice account without real money, then the spread prices may be lower than they are when you open a proper account. So anyway, on the right we have an example for you. So we're going to be trading GBP USD. You can see our ask price here, you can see our bid price here as well, and our spread is 2 pips, and as you can see there is a difference in 2 pips with the ask and the bid price. Now this is what the trade will look like. So what we're going to be doing is buying GBP USD. So we're going to be looking at the asking price. We're going to be trading 1 micro lot, so that's 0.01 lots, and we're going to be shifting around 1,000 units of Great British pounds. Now we do not need £1,000 to complete this trade, but we do need enough money to maintain this position, and you can see the equation at the end there. So without further ado, let's get on to margin. Margin is really important in trading and is needed to make trades like this. So what margin is effectively, it's not a cost or a fee, but it's a portion of the customer's account balance that is set aside in order to trade. It basically is like a deposit. It's required by your broker for you to put down in order to use leverage. And effectively when you run out of margin, you get what's called a margin call. Now on the left hand side again, we have some definitions for you. So initial margin is the deposit required to open a position, often called the deposit margin or just plain the deposit. And your variable margin is the money that must be available in your account to fund the present value of the positions and kind of cover any running losses, effectively meaning it's a covering thing. So your variable margin will move up and down depending on how your positions are doing. If they're doing well, your variable margin will stay cool. If your trades start to go negative though, you will need your variable margin to cover those losses. And once your variable margin exceeds your initial margin, so the money you need to cover exceeds the money you actually have, that is when you'll get what's called a margin call, and that is effectively a warning sent out by your broker. They will notify you when you don't have the appropriate available margin to maintain your positions. I think they'll notify you, they'll ask you to put more money in. If you don't, they will close your positions, and you either will be in debt or you will just have no money left. So let's get on to leverage. Now, what is leverage? Leverage is effectively, it's very common in trading. By borrowing money from a broker, investors can trade much larger positions in a currency. As a result, leverage magnifies the returns incredibly. It's important that Forex traders learn how to manage leverage and employ risk management strategies to mitigate Forex losses. Leverage is effectively like not a loan, but as a result of leverage, you can borrow money from your broker and it magnify your returns incredibly, as I've just said. However, there is a very risky thing to do. Leverage is obviously the use of borrowed funds, which means that it can be a double-edged sword. While it can help you generate enhanced gains, it can also accelerate your losses quite incredibly. So you really need to know how to manage it. Luckily, you're reading this blog, so by the end, you will probably know how to manage it. Now, here is the not sad, but the truth that every retail trader should really try and grasp before they start using leverage. Retail traders often use very high leverage to profit from relatively small price changes in currency pairs. This is very risky to do, as like, for example, huge amounts of leverage to supplement small amounts of capital increases your risk a huge amount. And in the bottom right here, you'll notice there is a rule in Forex that is pretty much proven, and that is 90% of traders you lose 90% of their capital in 90 days. Now that is a fact, and it's also very, very revealing as to what these brokers are doing with all this leverage. Why are they shifting huge amounts of money to give to people without really looking into, for example, when you take a loan from a bank, they look into everything. They look into whether you're going to be able to pay this back or not, and they look into everything about your past. But with brokers and leverage, it's effectively the same thing, but they don't really look in, they just ask for your name and your age effectively. So why are they doing this? Well, this is the reason, the 90-90-90 rule. Now, whenever you open a position with your broker, they take the opposite side of the trade, meaning that if you buy a currency, they will sell the currency at the same time. So your profit will increase. If your profit increases by 2%, your broker will be at a loss of 2%. So do you see what I'm talking about now? If the brokers are taking the opposite side of the trades and they know that there is a 90% chance that their new customers will lose money in 90 days, the more liquidity that they give the new traders, the more potential commission they make, because the more likely you are of losing your money and losing your trades, meaning that they make money, so their commission increases when your profits do not increase. And this is the wrong way to use leverage. As you can see on the right here, I have some examples of leverage that a lot of retail traders like to use: 50 to 1, 100 to 1, 200 to 1, and 400 to 1. Now you can pause the video and read through what I've said on this graphic here, but it's fairly simple. I want you to focus, however, though, on the 400 to 1. Now you need to be really careful about brokers that are offering this kind of leverage, as for it to be a worthwhile thing, you would have to have loads and loads of initial margin, and we're talking like big account size to make it worthwhile and to not make it to mitigate that risk properly. Now just beware of brokers offering this amount of leverage, as it can be very risky. Positions with this kind of leverage can probably close out in a matter of minutes, even seconds, with devastating effects. So you just need to be really careful. But yeah, make sure you read through these, pause the video, read through these, and understand how this is how retail traders use leverage. Big amounts of leverage, small amounts of capital equals big risk. Now let's look at how the pros use leverage instead. Now, professional traders usually trade with low leverage. Keeping your leverage lower protects your capital when you make a mistake, which will inevitably happen, and it keeps your returns consistent. Many professionals will use leverage amounts like 10 to 1 or 20 to 1, as it's possible to trade with that type of leverage regardless of what your broker offers you though. They won't advertise it, but you can still do it, and using the position size calculator will help you do that. You have to deposit more money. You will have to deposit more money and make fewer trades, but it's definitely worthwhile. At Logikfx, however, we recommend starting out using a leverage of 4 to 1. This means that your returns are small, however it's the best possible way to start trading, as your potential downside is very small. Eventually though, you can work up using higher leverage, maybe 8 to 1 and 10 to 1 when you get good, and once your trading strategy is really established and you have more capital at your disposal. Effectively, the more experience you have, the more leverage you should be able to use, which I think is a very logical way of using leverage. Now, by the way, Matty is going to be going through a video on how to use leverage, how to work out the best leverage for yourself, and how to work out the best leverage based on the amount of capital you have already. So, and all that information is also in the blog, so make sure you read, educate yourself. Gross exposure is the last thing I'm going to go through though. Gross exposure is effectively the amount of money that you're trading with when using leverage, and is calculated with a simple formula: current margin times leverage. So for example, if I had £1,000 and I wanted to trade with a leverage of 4 to 1, my £1,000 is my current margin, my leverage is 4, so that would be 1 times 4 equals 4,000. So my gross exposure would be £4,000, and that's how much I'll be using whilst using leverage as well. Now to the conclusion. Effectively, you just need to make sure you know about leverage. Do not fall for the tricks of brokers trying to squeeze every drop of commission out of you. You must understand how to manage leverage, and try not to make the same mistakes that a lot of traders make by taking advantage and taking liberties when using leverage. My advice would be educate yourself. Use sensible risk management and lot sizes to keep up manageable leverage, and watch your profits grow consistently and steadily. So thank you very much for watching the video and looking at the blog. Make sure to read through the blog, educate yourself, watch Matty's video. I'm assuming it will be on YouTube as well, so make sure you check it out there. And I'll see you guys in the next one. Have a great day.